Hello everybody and welcome to today's webinar. My name is Alex Madewell and I'm from the marketing team at Refinitiv. Thank you for joining us today for the webinar titled Implications of Coronavirus for Economies, Markets, Policy and the Regulatory Response. This webinar is part of a series brought to you by Refinitiv and Reuters exploring the financial impact of coronavirus and the response. Before I hand over to Richard Mabley, Head of News Performance at Refinitiv, who will be moderating today's discussion, I'll cover a few housekeeping points. At the bottom of the webinar landing page, you should see a toolbar with a number of applications that you can use. This toolbar ultimately controls your webinar experience and what you see on the webinar page. Feel free to open and close applications as you wish, but a few that I'd like to call out, firstly, is the Q&A box. So if you'd like to submit a question for any of our speakers, click on the Q&A application and submit your question. We'll be taking questions throughout the webinar and answering as many as possible. You can learn more about our speakers and their biographies in the speakers application section. And then finally, if you have any technical questions or queries, please click on the question mark or the Contact Us application and send us an email. We'll endeavour to resolve the issue as soon as possible. So without further ado, I'll hand over to Richard to kick us off.
Thanks, Alex. Thanks, everyone, for joining. And thanks to our intrepid team of Reuters journalists who are going to speak around a series of discussion points on the financial impact of the virus. We've got Michelle Price, who's the Deputy Americas Finance Editor for Reuters in Washington. We've got Mike Dolan, who's the Editor-at-Large for Markets and Finance in London. We've got Joe Mason, who's Reuters Company News Editor in Europe. And we've got Dan Burns, who is the US Economics Editor for Reuters in New York. So just to kick us off, can we just talk a little bit about what happened in January when the markets were setting all-time highs and when the story was sort of happening in China? So obviously, markets, market analysts, governments, everyone pretty much, journalists included, didn't think that this was going to spread as it has. Does anyone know of any credible voices warning in the market that there would be a spread? And was there anyone that that jumped ship in January when the markets peaked that we know of through your reporting? Mike, is that something you could talk to?
I think there are a number of hedge funds who've claimed that they got in early on this one, but I think certainly in terms of consensus, the feeling in January was very much that this was a China-contained health scare, and that the focus was entirely on how China would lock down Hubei province and how successful it would be, and there was some pretty good signs as we got into February that they were indeed extremely successful in doing that. So you got a mini V in the stock market at the time. Initial sell-off on worries about the impact on the world's second largest economy, and then a sense that they had got it in control. That was before we realized that it had gone far and wide. So I think in some respects, the preparation for, or at least the gaming that people would have done for a pandemic seemed wholly inadequate in one respect. Very few would have seen pandemic risk and the related economic shock that we're now seeing in front of our eyes as even in the mix in January. Certainly an extreme tail risk at best. And in many respects, the desire, if you like, to see it as a localized issue in China reflected, I think, how few people had seen this as a very likely event for the world at large. And despite the fact, and just kind of quick addition to that is the fact that if you look at what some of the experts in that area, or even some people looking at kind of big risks to the world economy, not least people moving into Davos in January, who were reading reports from the World Economic Forum that flu pandemic risk alone over the next 10, 20 years was likely to cost in terms of containment somewhere in the region of 0.7 to 1% of global GDP a year, and so the economics world and the etymologists of this world were shouting loud. But clearly, markets did not feel that this was even in the mix.
Yeah. No, fair enough. I think so. That's a little bit of history. So the other bit of history, of course, which is very, very relevant now, is 2008. If we could just go to slide number 5, please, Sufyan. The comparing crashes slide. What are the differences between now and 2008, which are, the writ large? It was a financial crisis last time. This is a medical crisis, a health crisis leading to an economic crisis. It has become something of a banking and lending crisis. Where do you see the similarities, and is the financial, is the banking system, broadly speaking, because we're going to get onto this in detail, in a fit state to keep this to keep funding going during this one relative to 2008? Dan, do you want to talk to that one?
Sure. Certainly it is, by all descriptions so far, not a financial crisis in the same stripe, right? Now, while there have been some dislocations, and certainly the Fed in the last 10 days in particular has acted to provide liquidity because of widening spreads in a variety of markets. It's unlikely, as we saw in 2008 and all the way through until 2010, to be something that triggers a wave of bank closures and bank bailouts, which were the core of the policy response back in 2008. Banks are far better capitalized, and Michelle can speak to this from her financial regulatory perch as well. The banks are in much better position with capital buffers. The question, of course, is in this case, given that this is such a crisis of confidence among consumers, among businesses, among all different levels of government around the world, what steps can be taken to keep credit markets open, to keep banks willing to lend, and we've seen the measures taken in the last couple of weeks. Now, breadth of financial losses at the moment, at least in terms of equity, are in percentage terms on par so far.
Absolutely. Can you stick up
equity value? Go ahead, Richard. Sorry.
Slide 6, Sufyan. Sorry, Dan. Just go through that again.
We lost ultimately, more than half of U.S. equity valuation overall in the crisis. Right now, we're at about a third. In absolute dollar losses, we're already on a parallel, right? In the U.S., it's $10 trillion through yesterday. I think globally, it's in the neighborhood of 20, with the U.S. accounting for half of that, and a lot of panic selling. And this is, you could argue, this is a fully rational response among equity investors right now, because the stock price is little more than a manifestation of an expectation of future earnings from companies. And right now, there's I challenge any analyst or economist to be able to put a really accurate estimate on what the hit to corporate profits is going to be here. As you've got right now, just with 5 states in the United States fully in some measure of extreme shutdown. That's 31% of the U.S. economy between California, Illinois, New York, Connecticut, New Jersey. So it's only going to grow, and I know we'll get into the question of whether the president can reopen the economy later, but this is certainly reflected in what we're seeing in equity prices.
Yeah.
Just to add to that, I think the comparison with 2008 as well is to try and kind of conceive of what's going on here in terms of the economy at large. And instead of a recession that's come through a business cycle or through Fed action or a banking crash. This is a recession that it will be deliberately commanded by the government. So this is, to get across this virus, there is a deliberate shutdown of the economy, especially in Q2. And you can see that in sort of some of the forecasts that are coming through from the big Wall Street banks, anywhere from Morgan Stanley and Goldman Sachs talking about annualized contraction in the US of anywhere from 25 to 30% in Q2, including JP Morgan talking about 14%. But these numbers are being updated almost by the day. And the world economy actually contracting in 2020 as a whole, which is an extraordinary event in itself, given that recession in the world is considered at 2% growth. Anything less than that would be considered a recession. To actually contract, we haven't seen that since 2008, and even the forecast contractions of about 1 to 2% for 2020 as a whole would be deeper than anything we've seen certainly in the last 30 years or so. But all this is being deliberately enacted. So in other words, the success in getting over the virus will be the success in stopping the economy. So from a market investment point of view, it's a completely different head shape to get around. And the fear of recessions of those levels and contractions of those levels is only relative to when you see this end. So it's become a game between the depth of the slowdown that's being commanded and the length of time it takes to get across the spread of the virus. So
I get your point. So the shutting down the economy obviously is a deliberate measure to contain the problem, which is completely the opposite way around to 2008. Let's go to the market reaction. I mean, I think everyone's seen, as we were showing earlier, the depth of the equities decline. The slide at the moment shows you stock market volatility, a new record set for the VIX yesterday. And this one, global sovereign debt yields, at desperate, at all-time lows. Can we just talk about some high-grade corporate debt? 10-year gains gone in 10 days. This was at the end of last week. That chart goes back to 2010. Is what the Fed doing now going to this signals the problem that companies are having? Obviously, will that liquidity issue now be fixed? Do you think as a result of what the Fed did yesterday, Dan?
Well, I mean, we're beginning to see some evidence of that. By yesterday, we saw some IG spreads come in. I mean, the Fed has effectively said, as my chief Fed correspondent Howard Schneider wrote in an analysis yesterday, the Fed is now the U.S. creditor in chief for the U.S. economy. Not just Wall Street, but Main Street and even City Hall, to the degree to which it's supporting the municipal bond market here in the U.S. now. And it looks like at least one of the versions of the rescue packages emerging from Congress could expand that authority even further. Yes, so it is effectively said it will provide unlimited liquidity to credit markets in the United States of all stripes now. It's backed up the commercial paper market initially, the money market mutual fund sector. It initially thought it was only going to need to provide about $200 billion of support for the mortgage-backed security market. It burned through that target in less than 2 weeks. And now has taken off on that side of the slate all the caps. So it has said it will put as much money at work as need be to ensure spreads come in, normal market function returns, and we're beginning to see some of that. There it is. I mean, as Howard, we noted yesterday, it's the Fed's moment yesterday is not to some degree unlike the James Morgan moment in 1907, half a decade before the Fed was even in existence. in one of the great early century bank panics when he gathered all the financiers to his library and said, "Bring me your assets and I will buy them." So who will buy? The Fed will buy, and they've made that an open-ended pledge. And I think that after some additional selling late yesterday, you're beginning to see that message reflected in some of the market activity today.
I mean, we'll get on to how this gets unwound maybe a little bit later. But so what you're saying is that basically the Fed has partly nationalized the U.S. Financial industry effectively.
I guess you could argue that. I mean, it's doing it in a way where it continues to have a bit of an arm's length relationship, but it is now the ultimate lender of last resort beyond Wall Street to Main Street. So it is a presence in the U.S. real economy now in breadth and shape, in a breadth and shape that is never previously been seen here. So,
yeah. Okay. We've jumped ahead a bit, but that's fine. I just wanted to flip back to markets though, and just talk about some emerging markets. This is a slide which shows the Institute of International Finance, which tracks emerging market capital flows. And they say that going back to January the 21st, that $70 billion has come out of emerging markets into cash and the dollar. And you compare that to other previous crises, that's the line in red. It's totally incomparable to previous times. We've talked, I think a lot of focus, if you're in the US and you're in Britain, you're in Europe, is on your own country. But this is massive for emerging markets. Does anyone, Mike, do you have thoughts on that, or
yeah, I mean, I think you got to see that in the context of really what the sequence of shocks were. I mean, clearly once we had the spread worldwide, the move to lockdowns, and the sort of recessions coming in place, the inevitable focus was on credit and credit lines. And how many companies would face cash flow squeezes and freezes, in fact, and whole sectors from airlines to travel and leisure and all that would literally be brought to a sudden stop. The scramble to run down existing credit lines was extraordinary, as well as obviously in the investment world, a dash for cash, and this manifested itself with a fairly severe shortage of dollars worldwide, at least shortage of dollar funding, that was one of the kind of I think the most severe parts of the first few weeks of this crisis, where we could see that in measures of dollar cross-currency basis swaps for euros, yen, sterling, all of that, those rates blowing out, and extrapolate that across to a scramble for dollars in lots of developing economies and emerging markets. You could see the amounts of kind of dollar debt in these countries, certainly on a corporate level, we're showing huge signs of stress, and the exchange rates reflected that. And the move to safety for many investors worldwide is typically a move home, and of course the homes of capital are typically in the developed economies, and therefore you do get a withdrawal from EM for that reason alone. But compounding the whole effect on EM, of course, was in the middle of the early part of the virus spread, the Saudi-Russia price war erupted. And, of course, for many emerging economies, which are heavily energy dependent, that was a double shock as well. So if you think of the Gulf economies or Russia or in some of the Latin American economies, again, the collapse in the oil price, near halving of Brent crude price following that war between the Saudis and Russians over the price, then that has really been a double whammy for many many EMs. But certainly the combination of dollar funding stress, the oil price drop, and a global recession inevitably, that, as we can probably talk about later, will have implications for globalization and supply chains and all of that for many years to come, I think. You can see why emerging economies, not least China itself, of course, which is a huge proportion of many of the indexes in EM, and China obviously at the brunt or at the beginning and taking the brunt of the Q1 hit economically. I mean, just to match up to some of those forecasts we talked about earlier, there's Chinese annualized contraction for Q1 is somewhere in the region of 30 to 40%. So the second biggest economy in the world, the biggest emerging market, and that's some flavour of why those EM capital flows were so severe. Yeah.
Okay. We'll go back to policy, but I was hoping to hear from Joe Mason, who's been, I think, pretty busy with the airline story, the airline industry story. Joe, this is I've just put up a slide which just shows this is the U.S. sectoral changes showing that energy, is the hardest hit, not surprisingly. Joe, tell us about the industry sectors in your patch which have been hit hardest, and whether there are any surprises, either on the downside or the upside.
Hello. Yes, so I suppose unsurprisingly, the airlines were the first to get hit by investor nervousness as news of the virus spread. But it was it's probably the Trump's restriction on travel that really just had plunged the market into an even deeper crisis, and it's been sort of a double whammy. Particularly, I'm in Europe, and the European airlines have faced a bit of a double whammy. They were hoping for a bit of respite this year. There have been some capacity cuts. Thomas Cook went bust, and they were expecting to be able to raise their ticket prices, and a little bit of the excess had been taken out of the market. But obviously that's not the case. And now we're looking at an industry that's looking for government bailouts, and we're really rather waiting for. I mean, I don't think we're waiting for an airline to go. Certainly, there's no real appetite. I don't think. I mean, Willie Walsh at IAG was quite explicit just a month ago, said he would not really be interested in picking up any bargains. So, even if there was an airline for sale, there's not much appetite for anyone to pick up a struggling carrier right now.
So I know, obviously, I should point out that Reuters journalists don't have opinions on, what's going to happen in the future. We report from other people on what they think. So I'm not going to ask you to predict which airlines are going to go bust first. But what are your sources or your reporters' sources saying about how they're going to track that? What's the sort of, in some cases you may get state intervention. In other places, the state has obviously stepped in a massive way. Surely, though, airline capacity is going to be too great after this, not least because of, fears of another pandemic, but because people will have learned how to do business without getting on a plane.
Absolutely, and I think that long term is that's the big fear in the industry, that this is the big reckoning, that that companies that have built an empire around our habits and our consumption rates and what we do day to day are unraveling fast, and the airline industry is feeling that in particular. I mean, you only need. I mean, there are businesses that are functioning without any travel at the moment that would have previously thought it unthinkable that they couldn't have a face-to-face meeting with a client in America, in Europe, in Asia, and they're finding ways to do it. In Europe, it's a particular headache because of the Greta effect. So the airlines were already having to provide and show that they are cutting their carbon footprint, and they've made strides there. And that's largely because the Greta effect has been largely focused in Europe, really. The Asian airlines have not been under as much pressure. So yeah, once we come out of this, there will be. It's hard to imagine that travel will ever be the same again. The industry uses SARS as the benchmark, but of course that's just redundant now. But under the SARS benchmark, the virus was contained within 4 or 5 months, and the travel industry had largely recovered within 6 to 9 months. But the experts are now forecasting that if we start to travel again later in the year, and we, albeit at lower rates, if they do contain it by the end of the year, it's not going to be until 2022 at the earliest that we see a recovery in travel and tourism and leisure. Does that make sense?
Yeah, no, that's fantastic. I'm just switching to a slide, bit of a complicated slide, but Mike put this one together. It's really interesting. Mike, can you just talk us through some of these lines? These are some of the big winners. I mean, we can just do this one quickly, Mike. Some of the companies which have done well out of this. Are there any surprises in those? What are they?
Not surprises. I think inevitably there's the sell-off, the 30+% sell-off in the big indexes disguised as an awful lot of things under the bonnet. Clearly, on one level, the most extreme hits are taken by travel and leisure, etc. Airlines, Boeing, I think, is the biggest dropper on the Dow, down about 60% or so at the worst point. And obviously the defensives have fallen less. But in this particular slide that we looked at, these are actual companies who've actually risen considerably since the beginning of the year. We're talking about online grocers like Ocado. We're talking about Gilead, who's developing drugs to ease the effects of the virus. There's also some online casinos in there. There's food producers, all the stuff that in lockdowns and in the hunkering down that we're all doing at the moment, the sort of companies that might actually benefit from the surge in demand. So some do win indeed, that's for sure. Although the vast majority, as you can see from the bigger indexes, are just going to be facing a very deep, however long, recession otherwise. Yeah.
And Joe, Dan talked a bit about liquidity getting back in, via the Fed yesterday straight to corporates. In fact, that's not happening in the European banking system quite so much, and it's not really recovered fully, the European banking system from 2008. So, is it in a fit state to funnel money where it's needed? I saw a really nice story, a Reuters story, about this issue in Italy at the moment. Even with rates at zero, is liquidity what's needed for the European corporate universe?
Oh, sorry, I was on mute.
Sorry.
And that's a good question. So I suppose the companies that are considered investment grade are faring a lot better. But there's a huge amount of, as Mike will know, a huge amount of risky credit profiles out there. There are 30% of companies with a risky credit profile according to S&P, and that compares with 20% at the end of 2015. So those companies are really good. They've got very little wiggle room. They're going to really struggle to raise any kind of cash. But there was an interesting, just the move overnight from the Fed seems to have eased things a little bit for any higher quality companies. I mean, Diageo and Nestle and Sanofi have no, ignore me, not yes, Diageo have launched bonds today, and the appetite was fairly decent for them. So that's a pretty good sign that that the logjam might have, well, has eased slightly.
So you're talking about quality, just like airlines. This is about the better quality companies will find things easier than others. It's easier to get money to those companies.
Exactly, and we've seen a couple of examples of companies where there's clearly a long-term. Well, I'm saying clearly, nothing certain right now, but some companies have been able to open new credit. Airbus, Boeing, Royal Caribbean got a new loan yesterday from a tier 1 bank, but with caveats. So the 2 board members had to take part in the loan too. So they had to help backstop the funding. So I suppose that's a sign that that the banks are. So it's not a European example, is it? But we have one from Cineworld as well, a cinema operator who managed to refinance. They were forced to refinance a loan without using equity as collateral. So it's slightly unusual refinancing, which was a sign that banks were making demands of companies that they trust them, but may be in short term.
Gotcha.
Maybe facing short term squeeze.
Gotcha.
Hey, Richard.
Yeah.
It's Dan. Just on the notion of winners and losers, and Mike was walking through that. I thought it was an interesting observation. The S&P is down 24% month to date through yesterday. There's exactly 12 stocks in the S&P 500 that are up month to date. And if you look at them, they are a narrative of how life is changing in the United States right now before our eyes. And as Joe mentioned, travel's changing forever. Top performing stock is Citrix System. It's up 18%. Of course, it's a cloud computing company, does a lot of mobile enterprise mobility solutions. I'm working from home. Everybody on this call is working from home. After that, you've got Kroger, Clorox, Walmart, and then the therapy makers, Gilead, Regeneron, Take-Two Interactive. Everybody's playing games at home with their kids. And delivery services. This is a tale right before our eyes of how this is reshaping how we're living our lives right now, and for at least the next month or so to come, and potentially longer term than that.
Well, I think that's a broader question, but why not we just have a quick explore of that at the moment? So when this all ends, are people going to sort of say, okay, our lives have changed, we're going to be thrifty, we're going to work from home, we're not going to travel, we're going to get food delivered rather than, trudging around a supermarket because it's more efficient? We really care about climate change, or some of us care about climate change, I should say. Or do you think, I've talked to my 2 daughters about this. One says, yeah, that'll happen, and the other one says, we're all going to go out and party like it's, 2029 or whatever Prince said, because, the world may end. Do you have a view on that, or do you think this is just entirely sort of feeble speculation on my part?
Is it too easy to say a little bit of both?
Yeah, maybe.
Racial thing. A little bit of both. I think there'll be some. I think the companies that are nimble now, and we're seeing that in the online food delivery, they are changing their business models by the day over here, cutting the restaurants. Basically picking up the restaurants have now become takeout company, takeout food restaurant, takeout food. They're scrambling to pick up the business from them, cutting them some slack now with the long-term plan of keeping them on when this is all over. So if you're nimble, Deliveroo has launched a new line of delivering Marks and Spencer's food today. That sort of includes all the pasta and stuff. I can't imagine. I mean, I realise that the demand is much higher right now, but it's the kind of buying habit that may well stick.
Yeah. Okay. Let's briefly do my favourite topic, which is oil wars. There's a slide up which shows oil in purple and the Dow Jones Index in green. There is a close correlation over time. Oil tends to be a bit more volatile. If this gets fixed, does that really help, or is it still just a demand issue? I mean, if the Russians and the Saudis were to say, okay, we're not going to fight for market share, does that make much of a difference these days? I mean, obviously, energy still makes up a decent section of the equity universe, but not anywhere near as much as it used to. Does anyone have a view on that? Mike, you talked a little bit about that earlier.
I mean, my only sense of it really, and you're probably closer to the ruins of OPEC than I would be, but certainly the demand issue will overwhelm this for the foreseeable future. I mean, again, going back, not to go over those numbers, but you know, if we see what we are likely to see, and today's purchasing managers indexes, the flash numbers are out around the world, gave us some glimpse as to what those forecasts are made from, then look, the energy demand issue is going to be overwhelming. To the extent that Saudi can put the genie back in the bottle and sort this out and try and stabilize it, it would help. Certainly, I think the prospect of oil going sustainably below $20 a barrel is mind-boggling for a lot of countries with break-even rates that are very, very high. And certainly for the big oil companies that are very large cap parts of our equity indices, then clearly that's disaster territory as well. Also, you have to remember in a credit shock, which is partly what we're going through at the moment, that in the high yield space in the US is hugely dominated by shale oil companies, and so junk bond territory. Clearly, with oil sustainably falling much further than it has done, then clearly that's going to cause all sorts of additional stress in that space as well. So it does have an impact. It does have an accelerator effect, as I said earlier. So to the extent to which Saudi and Russia can sort this out and come to some agreement to limit supplies, it would at least stabilize things, if not kind of rethink your trajectory for the oil price. Certainly, the other thing, of course, that's worth mentioning is that in all the policy bazookas that have been fired for the past 2 or 3 weeks, it's been notable that there's been an absence of coordinated efforts, and lately, in the last 2 or 3 days, literally, we've seen a little bit more of that. G7 is now holding daily conference calls amongst its finance chiefs, but G20, which was the forum by which 2008 rescue was conducted in the London summit in 2009, and Gordon Brown as chair at the time. And if you look at who's in the chair of G20 right now, it's Saudi Arabia, which raises questions about just what was Saudi doing, conducting a hugely destabilizing price war in the middle of all of this, and does it have its eye on the ball of the sort of kind of grand scale of global rescue that another chair might have more reasonably put together?
Well, you've answered that question I was going to ask you. I mean, clearly the G20 is totally. I mean, it's a victim of the trade war because China and the US are at odds, obviously, and MBS probably has a different point of view than Gordon Brown had. So yeah, I think we can probably put the G20 to bed as an effective force, particularly in this crisis. Michelle, let's go over to you, please, in Washington on the financial regulation side. You've been covering a story where obviously after 2008, under Barack Obama, there was a big clampdown on what banks and traders were allowed to do. There's been quite a debate since Donald Trump came to power about whether that would be loosened. What steps are being taken now, and what is being discussed about what might come next for undoing what was done in post-2008? You there, Michelle? You may be on mute. Okay, Dan, do you want to talk to that one?
Sure. Do you want to just repeat the question? I'm sorry.
Yeah. So the question was around post-2008 deregulation of the banking system, and since Donald Trump came to power, some of that has been a little bit of that's been dismantled. Does that now accelerate? Does the banking?
Hey, sorry, can you hear me?
Yeah, I hear you now, Michelle. There you go.
Hi, sorry, I was having an issue with my headphones. Sorry about that. Yes, I mean it is really interesting because this is the first big test, right, of the the enormous measures which were taken after 2008, and certainly the Trump administration has, with the help of Congress and the executive agencies, loosened some of those rules. But fundamentally, the main pillars of Dodd-Frank, was still in place going into this crisis, and I think. The jury's still going to be out, right? This is going to take some time to play out, but fundamentally speaking, it looks like those rules so far have done their job. The banks are flush since 2008 with about sort of $800 to $900 billion worth of extra capital. They had very highly liquid capital buffers, which they've been able to use to support corporate drawdown. So I think. I think fundamentally that looks to be in pretty good shape. I think, one of the interesting questions though is around pro-cyclicality, right? So at what point during a crisis do these rules start to actually exacerbate some of the problems? And so the Fed and the regulators have actually been pretty quick at trying to get ahead of that question. And, one of the interesting discussions that we've been reporting out is the Fed actually really trying to get the banks to use those buffers. And some of it speaks to a little bit of the the post-traumatic stress disorder that the banks had after 2008, when the Fed and other supervisors were very tough on them when it came to enforcing the rules. And so, they've asked the Fed for certainty. They've said, listen, we'll use our buffers, but we want to know that, if we go under certain key cash thresholds, that you're not going to come in with your stick and beat us around the head, in 6 months' time. So that's one of the key discussions between the banks and the regulators is sort of like, how low can you go? How lenient will you be on us? And so they're still seeking some clarity over that. So broadly speaking, I think it's going to be difficult for the industry to argue that the post-crisis rules, generally speaking, haven't worked well. I think at the moment, the feeling is that they've sort of proved their legitimacy. Right.
Okay. That's interesting. So one of the things, maybe this isn't quite so much an issue now, but one of the issues in the markets for a week or so there was a draining of liquidity around debt markets, particularly long-term debt. And of course, post-2008, the banks were taken out of their market-making role to prevent conflicts of interest, that sort of stuff. So that left no one to warehouse risk. In the last couple of weeks, there was this huge sort of vacuum there. Do you think they'll argue that they should be allowed to return to that space?
Yeah, so I'll just say a few things. I think Dan is also really well placed to jump in on this one. So it seems to me you're sort of broadly referring to the Volcker rule, which restricted market-making activities, and there was some controversy right around this issue. I believe there was a Fed study done which seemed to question the kind of the narrative that the Volcker rule had actually affected liquidity in treasuries, and Dan can speak a little bit more to that. Over the past 2 years, the Fed has and the other banking regulators have already loosened aspects of the Volcker rule, and we know from our sources that there is a huge reluctance to go down that path again. It's an excruciatingly complicated rule. It's highly politically controversial. The first rewrite of the rule, which they announced in 2018, effectively had to be redone because of some issues with that. So the feeling from sources is that it's unlikely they would want to try open that can of worms again.
Yeah.
But there are other areas of the post-financial crisis framework which have affected liquidity, which we've also written about with respect to the repo market. And perhaps, Dan, you could kind of jump in there. There has been a little bit of discussion around that. Dan, do you want to talk a little bit about specifically treasuries?
Well, actually, Dan, if you don't mind, because we're running out of time, I'd like to get to some questions from our audience. Can we just go briefly back to the policy reaction, because we've got a big policy question which is not yet signed off, the $2 trillion package which is still in Congress, which is for individuals, small businesses, loans, etc. Is that now a foregone conclusion, and is that priced into the market?
Well, I would think that it's beginning to be. I mean, what it will look like is still uncertain. There appears to be movement on a bipartisan agreement on the Senate version, but of course now in the House, Speaker Nancy Pelosi has posted overnight her own version of the House version of what they'd like, which not surprisingly is less tailored toward corporate bailouts and grants while they're still in there than it is toward expansion of social safety nets for individuals and households, improved unemployment benefits, et cetera. So what it ultimately looks like in the next 24, 36, 48 hours is a bit of anybody's guess. It'll be, I think, in terms of ballpark size, $2 trillion is certainly increasingly looked at as the smallest it could be, and certainly it could even get larger. Questions around what are the direct payment provisions to households, what are the income cutoffs associated with that for these $1,200 checks that are $3,000 for a family of four, and what are the rescue packages in terms for companies. Certainly, I can't imagine that there will be a corporate assistance provided here that does not have strings attached around things such as stock buyback restrictions and executive compensation. So if you're running an airline, you want help right now, you'll probably get it, but you're not going to be buying back your stock, and your CEO is not getting a pay increase anytime soon.
That's terrible.
And I just to add to that, just to get us bang up to the minute, really. I mean, there is a decent bounce back today. We're up about 6-7% on Wall Street. In Europe, we're up 6% as well. Some of the worst kind of credit measures, sort of the IG, ETFs in investment-grade corporate debt and stuff, are bouncing back. CDS is easing off, and dollar is easing off. So I think the scale of measures coming through is clearly anesthetizing the kind of the worst of the credit problem, certainly for a bit. But everyone we talk to, and I think and this is true of I'm sure everyone else on the call as well, that no matter how much you throw at this will it's crucial that the actual virus itself actually starts to crest. And I think one of the bits of the optimism for the last day or two has been that in Italy, which is kind of the worst outbreak outside of China, there is some sign that the increase in the infection rates is beginning to slow, and I think that's absolutely crucial, as much as any of the trillions of dollars of support that's been put. If that doesn't happen, all bets are off.
Yeah, well, of course. So let's go on to that because we haven't got long to go.
Okay.
That absolutely is one of the, to use a probably inappropriate phrase, it's a fundamental, right? I mean, it's a fundamental piece of data. What's happening with the spread and the mortality rate. Yesterday, the U.S. President Trump talked about weeks, not months, to reopen the U.S. economy. But of course, if that means a large and growing number of deaths, and which pushes that out longer, in that case, then you will need to. It seems to me that there's a sort of terrible trade-off here. And if you say, well, I want to save the economy and we're going to sacrifice some people for that, you may end up in you don't actually fix the situation simply because the virus is allowed to grow and spread further.
Yeah, that's quite. We had a couple of stories in the last 24 hours around Trump's assertion that he'd like to reopen the economy. He's clearly getting an earful from pretty hardline conservatives, people like Stephen Moore, et cetera, who are arguing that the cure is worse than the disease here. The issue, of course, is where if you've already taken this measure and you only went halfway, and then you don't end up flattening the curve, as they like to say, you haven't restored confidence. One, there's a question in the face of individual state orders to close down establishments, what effect Trump could actually have in trying to reopen the economy in New York, California, Illinois, Connecticut, New Jersey, and others that are considering taking these measures. And then on top of that, are you going to go out to a restaurant where you don't know that everybody serving there and preparing food or sitting next to you as well? I kind of doubt it. So what type of order that has, and then what does it do to your trading partners? Trump could reopen the airports tomorrow and tell airlines to fly, but who is going to fly here right now to New York? So I think there's a lot of questions to be asked around such an undertaking.
We've got a question from the audience, and we don't have long left. So this is a question about the effects of central bank policies down the road. I think it's a really good question. All this money out there, does that cause inflation, or because of the demand issue, which has been the issue since 2008, against many predictions, actually, is deflation going to be the problem down the road? Now, I know you don't know the answer, no one knows the answer, but it's a good question. In the last few minutes, what are people beginning to model on the likes of economic growth for the year and inflation versus deflation? Mike, do you want to give that a go?
Inflation. For a bit of inflation. I'm not going to speak from a European perspective, at least. We're talking about 5-year inflation expectations somewhere in the region of 0.5% to 0.6 or 0.7%. The problem is not inflation right now. It's a reasonable question to ask. Does it build up a series of policy changes and are enough policy taboos broken that we end up in a place where inflation is unleashed over a generation? I think that's a reasonable question. For now and for the foreseeable future, inflation seriously will not be the issue. The big questions that come up policy-wise, and Dan will speak in the States, certainly in Europe, is around issues of money printing or helicopter money, as it were. A lot of what's happening now is direct cash going into the pockets of businesses and workers who are furloughed because of this lockdown. That will be necessary. The question is, how is it funded? We're talking about budget deficits going to wartime levels, World War II we're talking about here, 10% or more of GDP, with I think forecasts for US debt to GDP to go to record highs above 106%. So the debt levels that will be accumulated as a result of these rescues will be gigantic. The question is, how are they funded? We know the mistakes of post-2008 were in effect that they were clawed back very quickly through austerity programs, certainly in Europe again, maybe less so in the States. But this time around, the big question is, modern monetary theory and helicopter money and all of these issues that allow central banks to effectively underwrite the sort of debt that's been needed to incur for these rescue packages. Does that create inflation further down the road? The ability to be able to manage that, make it temporary, and not allow it to become a political plaything, I think probably is the answers to that. But for the foreseeable, certainly inflation won't be the problem. It will be preventing a deflationary environment.
Right. And just to talk briefly about modern monetary theory, this is something which no one thought we'd probably see. It was, I guess, it's not a Joe Biden policy, at least, and it looks like he'll be the presidential candidate. However, we've got it, and we've got it from a Republican government. We've got it from a conservative government in Britain. Is this just a temporary thing? Would you expect to go back to austerity to pay off that debt, or is modern monetary theory here for good, or for the foreseeable future, beyond the crisis, I should say?
Have you ever known the U.S. Congress to enact austerity?
No, that's true. Yeah, you're right.
I can't imagine it being the case here. I think it's deficits to the limit from here on out. Whether
you've got a dollar. We don't have the luxury of your currency.
Right. I mean that's the premise that the core of modern monetary theory is we are the world's reserve currency. All of our debts are printed in our own money, and we can print as much as we need. Is at least the theory. And then as long as the money is potentially put to productive use, infrastructure, et cetera, wouldn't be surprised. Certainly wouldn't be surprised to see programs such as that emerge from here. Going forward, but as Mike says, it's deficits, sky's the limit there. But I have a hard time seeing inflation take root here anytime in the near term.
Okay, and just we've got a couple of minutes. So I put up a slide just showing some of the forecasts which are coming in from the bigger banks. A Reuters poll showing, this is last week, 76% of economists at Reuters polls saying that we're already in a global recession. Are these numbers still optimistic, do you think, or do you think they are they beginning to coalesce around, the sort of figures we're seeing here? The U.S. economy shrinking 25% in the second quarter. Goldman is projecting, that was their first go at this.
It's going to be. We will see certainly a double-digit contraction in the United States in the second quarter. The question is, through policy actions, through efforts to hopefully successfully contain the spread of the disease, is it a V or is it a U?
Or an L.
Or an L, yeah. That's the worst. I've never seen that letter used for an economic recovery because it's not actually a recovery. But I guess it's V or U is what we've got to hope for. And I guess today's markets are saying V, but tomorrow's markets may be saying something completely different, right?
Yes. It changes. The optimism changes day by day. And certainly I wouldn't take a read on the future from one day in the market.
Yeah. And it's sort of one of the signs that the market may have bottomed, a reduction in this volatility.
Sorry, I didn't hear that. Could you repeat?
Yeah, well, so markets are incredibly volatile, right? I mean, record volatility according to that VIX chart from earlier. Is one of the preconditions that the stock markets have bottomed an end of volatility, or do we just go from very volatile crash to a volatile recovery?
Well, this is. I mean, certainly in terms of markets. I mean, I think it's very, very interesting that yesterday we got quite a big shakeout, another big drop in Wall Street, but volatility levels came down. So, we're on today. I think it's the fourth session in a row that the VIX has fallen, albeit we're still high up and above 50%, which is, eye-watering levels of implied volatility. But it has to come down for the markets to stabilize. Absolutely. I think what we saw in kind of, VAR-driven funds, the risk parity funds, was a violent sell-off in risk assets related to the spike in volatility. They simply can't hold this sort of stuff with volatility at these levels. So a precondition for market stabilization will be that vol continues to subside. Interestingly, the VIX never topped the 2008 peak in this one, albeit got very close. But we would need to see kind of average volatility, and we're talking 200-day moving averages, something not kind of crossing 20%. At the moment, it's rising close to 18 or 19. But absolutely, it has to subside. Otherwise, it's impossible for many funds, particularly retail funds, to hold any of these assets.
Okay. Well, look, we've run out of time. Dan, did you have a thought on that? You said something in another conversation. So, well, look, thanks everyone for joining. Thanks for the audience for listening in. Thanks, Michelle in Washington, Mike in London, and Dan in New York. Thanks for keeping us up to date. I know you're all working as the whole of Reuters is doing a fantastic job. I've got to say, I worked at Reuters for 25 years, and I never worked as hard as any of you are at the moment. So keep up the great work. Thanks for delivering what is the best news service in the world for financial clients of all sorts. You're doing a brilliant job. And if people want to listen to this again, it'll be on record and we'll get sent around. Thanks, everybody. Bye for now.
Bye.
Bye. Bye-bye.